Hey everyone, if you're worried about Moody's recent downgrade and what it means for your money, you're in the right place. Today, I'm going to show you how to turn this crisis into your biggest opportunity to make real money, even if you're feeling overwhelmed or broke right now. Stick with me because by the end of this video, you'll know clear, actionable steps to protect your finances and start growing your income, no matter what the market does next. Before we dive in, do me a quick favor. Hit that like button and subscribe to this channel. Here, I share no-nonsense strategies that help people just like you escape debt and build financial freedom. Let's get started. Picture this. You wake up, check the news, and see Moody's just slashed a major credit rating. Stocks are tumbling, headlines are screaming recession, and your stomach drops. What does this even mean for your savings, your job, your future? A Moody's downgrade isn't just some Wall Street jargon, it is a seismic shift that can ripple through your wallet. When a country or company's credit rating gets cut, it's like their financial report card just got an F. Borrowing money gets pricier, investors get spooked, and markets start to wobble. Jobs might tighten, prices might climb, and your 401k could take a hit. But here's the secret nobody's telling you. While everyone else is panicking, this is your moment to strike. Downgrades create chaos, and chaos creates deals, if you know where to look. Let's break it down. Right after a downgrade, markets go wild. Stocks might crash, bond yields spike, and interest rates creep up. Most people see this and freeze, or worse, they sell everything at a loss. Big mistake. History shows us that downgrades, like the US debt downgrade in 2011, often lead to short-term panic but long-term opportunities. Back then, the S&P 500 dropped 6% in a week, but by the next year it was up 16%. Why? Because smart investors didn't run. They bought when prices were low. The lesson? Volatility is your friend if you're prepared. To get ready, start by checking your financial pulse. How much cash do you have on hand? Are your investments diversified? Do you have an emergency fund? If not, don't worry. I'll show you how to build one fast, even on a tight budget. Now let's talk about where your money should go when the market's shaking. Not every investment tanks during a downgrade. Some actually shine. Government bonds, especially US Treasuries, often become safe havens because they're backed by the government's promise to pay. Defensive stocks. Think companies like Walmart or Procter & Gamble hold steady because people still buy toothpaste and groceries no matter what. Sectors like utilities or healthcare are like financial bunkers. They don't budge much in a storm. Want a real-world example? During the 2008 financial crisis, while the market crashed 38%, utility stocks only fell 10% and recovered faster. Diversifying into these areas now can protect your money and set you up for growth. A simple rule: aim for 20–30% of your portfolio in these stable assets to balance risk without missing out on gains. But here's where it gets exciting. Downgrades create fire sales. When investors panic, they dump assets and prices fall, sometimes way below what they're worth. This is your chance to buy low. Take real estate, for example. After a downgrade, property prices might dip as borrowing costs rise, but demand for rentals often stays strong. If you've got some cash, snapping up a rental property at a discount could mean steady income for years. Stocks work the same way. In 2020, after global downgrades hit, companies like Apple and Microsoft saw temporary dips, but soared 80% within 18 months. The trick? Patience. Don't expect overnight riches. Research solid companies with strong fundamentals, low debt, steady revenue, and buy when others are selling. Tools like Yahoo Finance or Seeking Alpha can help you spot these gems before the crowd catches on. Now let's talk credit, because used right, it's a wealth-building rocket. After a downgrade, banks might tighten lending, but if you've got a decent credit score, you can still access loans or credit lines at reasonable rates. Why does this matter? Because cheap money lets you invest in opportunities others miss. Say you borrow $10,000 at 5% interest to buy a discounted rental property or fund a side hustle. If that investment grows at 10% a year, you're pocketing the difference. The catch? Discipline. Never borrow more than you can repay, and always have a clear plan. In 2009, entrepreneurs who used credit to start businesses during the recovery, like Airbnb, turned small loans into billion-dollar empires. You don't need to aim that big, but you get the idea. Strategic debt can be a tool, not a trap. Here's where most people screw up. They panic, chase get-rich-quick schemes, or ignore their finances altogether. Panic selling locks in your losses. Chasing crypto pumps or sketchy hot tips usually ends in tears. And neglecting basics, like a budget or emergency fund, leaves you exposed when the next crisis hits. Want to avoid these traps? Start with a simple budget. Track every dollar using apps like Mint or YNAB. Aim to save 3 to 6 months of expenses in an emergency fund. If you've got high-interest debt, pay it down fast. Even $50 extra a month on a credit card can save you hundreds in interest. These moves aren't sexy, but they're your foundation for winning in any market. Mindset is your secret weapon. The difference between people who thrive after a downgrade and those who crash isn't luck, it's discipline. Successful investors don't obsess over daily market swings. They stick to a plan, stay patient, and keep learning. Take Warren Buffett. During the 2008 crisis, while everyone panicked, he invested $5 billion in Goldman Sachs at rock-bottom prices. That bet paid off tenfold. You don't need his billions, but you do need his mindset. Focus on value, not fear. Start small. Read one article a day on Investopedia. Listen to a podcast like The Motley Fool, or join a financial community on Reddit. Every step builds your confidence and sharpens your instincts. Let's get tactical. How do you spot opportunities others miss? It's about seeing the signals in the noise. Market data, like price-to-earnings ratios or bond yields, can show you what's undervalued. Historical patterns, like how markets recover after downgrades, give you context. Expert insights from analysts on Bloomberg or X-Posts from finance pros cut through the hype. But don't just follow the crowd. Verify everything. If a stock's trending on social media, dig into its financials before you buy. Trust your research, and you'll be ready to pounce when prices hit rock bottom. Pro tip: set price alerts on platforms like Robinhood to know the second your target stock dips into bargain territory. Tools are your lifeline. Use Bloomberg or Yahoo Finance for real-time market data. Invest with low-fee platforms like Fidelity or Vanguard to keep more of your money. Track your spending with Mint or Pocket Guard to stay disciplined. Educate yourself with free resources like Investopedia or YouTube channels like Graham Stephan. Join forums like Boggleheads to swap ideas, but always double-check advice. These tools aren't just nice-to-haves. They're how you stay ahead of the game. Now let's level up. When markets tank, advanced strategies can amplify your gains, if you're careful. Options trading, for instance, lets you hedge against losses or bet on price swings with limited risk. But it's complex, so start with free courses on Khan Academy before diving in. Hedge funds or distressed asset funds can profit from market chaos, but they're often for high rollers. A simpler move? International diversification. If a US downgrade shakes Wall Street, markets in places like Singapore or Switzerland might stay stable. ETFs like VXUS let you invest globally without picking stocks. Whatever you choose, research deeply and start small to avoid costly mistakes. Here's a game changer. Build multiple income streams. Relying on one paycheck is like betting your future on a single stock. Risky. After a downgrade, side hustles or passive income can be your safety net. Got a skill? Freelance on Upwork or Fiverr. Got $500? Buy a dividend stock like Coca-Cola for steady payouts. Got time? Start a blog or YouTube channel. It's low cost and can grow into real money. Rental properties, if you can swing them, bring cash flow even when markets dip. In 2020, people who started online businesses during the downturn, like e-commerce stores, saw 30% higher growth than traditional startups. Pick one idea, start small, and scale as you learn. Your brain is your biggest asset, or your worst enemy. Too many people let fear or self-doubt stop them. I'm not good with money, they say, or I'll invest when I have more. That's a losing game. Rewire your mind with daily habits. Write down 3 financial goals every morning. Visualize your success. Picture paying off that debt or buying your first rental. Read books like Think and Grow Rich or take a course on Udemy. Small actions compound. In 6 months, you'll be shocked at how confident you feel. Discipline isn't just about money, it's about believing you can win. Let's wrap this up with a plan. Step 1. Today, review your finances. List your debts, income, expenses, and investments. Step 2. Set goals. Want $5,000 in an emergency fund by next year? Write it down. Step 3. Take one action. Open a Robinhood account. Cut $20 from your budget or read an article on bonds. Step 4. Keep learning. Subscribe to this channel for weekly tips. Follow Finance Pros on X and join a community. Step 5. Diversify your income. Pick one side hustle and start this month. Write these steps down. They're your roadmap to turning this downgrade into your comeback. You've just learned how to make money after Moody's downgrade by staying calm, spotting deals, and acting smart. You don't need to be rich to start, just willing to learn and move. If this video lit a fire under you, smash that like button and subscribe for more strategies to ditch debt and build wealth. Drop a comment. Which step are you taking first? Let's build a community of people who win, no matter what the market throws at us. For exclusive courses and mentorships to fast-track your success, check the description. Your financial freedom starts now. Don't wait for permission. Choose to win.